South Africa's consumer price index recorded a marginal increase to 4.8% in August from 4.6% in July due to a tick-up in oil prices.
Food is a positive contributor. Although oil prices have gone a little bit up and we've seen petrol prices go up as well, the impact has not been very dramatic on the retail side because the rand has offset the impact.
The rand has remained relatively stable since the last MPC meeting in July, although it has been trending weaker in recent weeks due to geopolitical concerns. But lower food prices are helping keep inflation in check.
So the government will be set in looking at the outlook going forward, and it is clear that inflation is likely to fall, and the prospects of inflation going forward are still hinging on a weaker currency, admittedly, but on balance, I think the risks are on the downside, and that should give him comfort to continue what he's done previously, reduce interest rates by 25 basis points.
The Reserve Bank cut the repo rate by 25 basis points to 6.75% in July, bringing prime to 10.25%. Heavily indebted South Africans are hoping for more relief, but it may still be too little to stimulate economic growth.
Coming from a very difficult economic environment, there's very high unemployment rate. There's also confidence level from both the business and the consumer side being quite low. Rate cuts are good because they put a few cents back into a consumer's pocket, but it's not money that will stimulate the economy through consumption.
While most economists are expecting another rate cut, the Reserve Bank may just take a more precautionary approach. The US Fed is also meeting, and if it hikes rates, the rand could take strain. Oil prices could tick up further due to damages caused by the hurricanes in the Gulf of Mexico that's likely to delay output. And emerging markets could suffer the fallout of heightened tensions between the US and North Korea. Sumitra Nydoo, CGTN, Johannesburg, South Africa.